SIPPs versus ISAs. Both SIPPs and ISAs are tax-efficient investment wrappers, but how does each one work and which should you, as a UK business owner, choose? In this video, we'll be comparing the two, and if you stay till the end, I'll provide scenarios for where each is best suited. Before we begin, my name's Joe. I'm a UK-based chartered accountant and founder of E-commerce Accountants, the UK's leading accountancy for e-commerce businesses. You can find out more about me and my team in the link below. Let's begin with the basics. First of all, what is an ISA? ISA stands for Individual Savings Account. They are tax-free wrappers for your savings and/or investments. But here are the key points that you need to know, and then we'll compare the same for SIPPs in a moment. There are 5 types of ISA available: cash, stocks and shares, lifetime, innovative finance, and junior ISA. Contributions. Transfers into ISAs are made using post-tax personal funds. In other words, you should have already paid tax on this money and no tax relief will be due when you make contributions into your ISA. Annual allowance. Currently, this is £20,000 per year, and this allowance is spread across all of your ISAs. Meaning, if you have 2 ISAs, you can only put a maximum of £20,000 across both of them, rather than, say, £20,000 into both. Access. Typically, you can withdraw your funds from an ISA at any time, although there are some specific rules for lifetime ISAs or LISAs, which we'll touch upon later. Tax on investments. In an ISA, all income and gains are free from capital gains tax, dividend tax, and income tax. Withdrawal tax. There is currently no tax payable when you withdraw money from an ISA. Here's a table of features and rules applicable for each type of ISA. Pause now if you want to take a closer look. What is a SIPP? SIPP stands for Self-Invested Personal Pension. As the name suggests, this is a personal pension that allows you to control how much you invest for retirement. SIPPs also provide some serious benefits for limited companies, or for the directors of them. If you run a business, you should definitely check out this video dedicated to that, but here are some of the key points of a SIPP. Contributions. Unlike with an ISA, these can be made with pre-tax funds directly from your company, or if made from your personal funds, which have already had tax applied to them, you'll receive tax relief on the contribution and a top-up in your SIPP, essentially to make the funds pre-tax. Employer contributions. Your company, if you're a director, can directly make contributions into your SIPP. These contributions are free from income tax and national insurance, while also being corporation tax deductible. Annual allowance. Generally, this is £60,000 a year. However, it can be reduced based on your earnings, which we'll touch upon later. Access. Money is locked in your SIPP until you turn 55. That's rising to 57 in 2028. Tax on investments. Investments within the SIPP grow tax-free. Withdrawal tax. Initially, you can withdraw 25% of the fund completely tax-free as a lump sum. This is one of the main benefits. After this, the remainder is taxed as income as and when you withdraw it. This table shows some of the most important SIPP rules. Pause now if you want to take a closer look. Unlike salaried employees, as a business owner and director, you have added flexibility when it comes to paying yourself, and especially in terms of planning for retirement. ISAs and SIPPs offer different advantages depending on your preferences and goals. This table compares the accounts. Firstly, how much can you put into each account each year? The annual allowance for SIPPs is currently £60,000. With ISAs, the contribution limit is much lower, currently £20,000 per tax year. What happens to the unused allowances each year? For ISAs, each year, your annual allowance resets on the 5th of April. Any unused allowance is completely lost. Essentially, if you don't use it, you lose it. For this reason, I think it's really important to try as hard as possible to utilise your ISA allowance each and every year, especially if you have a flexible ISA. Since you can always deposit cash into the ISA at the end of the tax year on, say, the 5th of April, this will use or protect your allowance with the option of then immediately withdrawing it on, say, the 6th of April. If you do this over multiple years, you'll be in a really good position, but that sort of strategy is probably a little more advanced than I intend to go into in this video. We'll be looking at that in the future. On that note, if you haven't already subscribed, please don't forget to click that button now. Pensions, on the other hand, are a little bit more complicated. You're allowed to carry forward up to 3 years' worth of unused allowance into the future. This means that if you put £10,000 into your pension in year 1, you would have £50,000 of unused allowance that gets automatically carried forward into year 2. So assuming the annual allowance for pensions stays at £60,000 for year 2, you'd actually have a £110,000 allowance for that tax year. A really quick important point here, but you can't actually start carrying forward any unused pension allowances until you've actually set up a pension. So if you haven't set up a pension yet, I'd strongly recommend it, just to ensure that unused allowances begin to build up. Simply setting up a pension or a SIPP somewhere and putting in something small, whatever the minimum contribution might be, which is usually £100, that'll do the trick. That means you can then start carrying forward unused allowances. You really don't want to find yourself in a position where suddenly you can make these additional contributions and potentially save quite a lot of tax, only to be let down by having not taken action 2 or 3 years earlier. Anyway, back to ISAs versus SIPPs. If you own a company, can your company contribute to these accounts directly? With ISAs, unfortunately, the answer is no. With SIPPs, yes, they can. And this is where they really come into their own. Another advantage that SIPPs have over ISAs is that SIPPs can be used to purchase commercial property. Now, in theory, your business can then rent this property from the SIPP, whereas with an ISA, you can't do this. On the flip side, the biggest drawback for a SIPP is that the funds deposited into a SIPP can't be withdrawn currently until you're 55. ISAs, however, are readily accessible. Finally, what about tax? ISAs are really straightforward here. Anything you withdraw from an ISA is not subject to tax. SIPPs, however, are usually built up of pre-tax income. So there are taxes applied when you do eventually start to withdraw funds from them, based on whatever your applicable rate of income tax is when you make the withdrawal. That being said, there is one additional thing to mention here, and it's one of the main reasons to get a SIPP, and that's the tax-free lump sum. What is this? To put it simply, when you first retire, you can withdraw 25% of whatever is in your SIPP as a tax-free lump sum. That means that each year you can put, say, £60,000 from your company straight into your SIPP. Let's say you did that for 10 years. If we ignore any potential gains made by the pension, you could then take out £150,000 tax-free. This is a huge advantage and really shouldn't be overlooked. So that's the basics covered. Let's now recap and discuss where each product might be better or more suitable for a business owner. First, where is an ISA better than a SIPP? Number 1, flexibility and accessibility. For the most part, with ISAs, you can instantly access your money. So an ISA is a better choice if you're looking to invest, but want the additional liquidity. This then could be used to further grow your business, purchase property, or is just on hand in case of emergencies. Number 2, purchasing your first home. If you're between 18 and 39 and you're planning to buy your first home, then don't underestimate the benefits of a lifetime ISA or LISA. Unlike a SIPP, funds in a LISA can be withdrawn to buy your first home. We've previously covered LISAs in detail in this video here, but the key points to remember are as follows. First, the government adds a 25% bonus to any contributions that you make into the LISA. The maximum you can contribute each year is £4,000. This means that the maximum government bonus is £1,000 a year. Yes, essentially that's £1,000 for free. The biggest drawback is that you can only withdraw the money to buy your first home, and that's up to £450,000 with a mortgage, or upon retirement after the age of 60. Withdrawing outside of these two windows or rules does incur a 25% penalty on whatever the withdrawal is. So similar to investing into a SIPP, be sure that you won't need access to the money before investing into a LISA. So where is a SIPP better than an ISA? Firstly, long-term tax-efficient investment for directors. Unlike with an ISA, you can make employer contributions directly from your company into your SIPP. If you're looking to extract money from your company to invest it for the long term, then this is a far more tax-efficient method compared to extracting the money as a salary or dividend and then investing it personally. Here's why. Contributions are seen as business expenses, which reduces your company's corporation tax bill. If the company has profit, you're going to have to pay corporation tax anyway, so why not invest that in your SIPP and reduce your corporation tax bill? A £20,000 SIPP contribution could save your company between £3,800 and £5,000 in corporation tax, depending on your company's corp tax rate. There's no national insurance. Unlike your salary, any employer contributions won't be subject to employer or employee national insurance contributions. Compared to taking the same in form of a salary, a £20,000 SIPP contribution could actually save £3,000 in employer NICs. No income or dividend tax. Unlike salaries or dividends when they're paid to you, employer pension contributions aren't subject to the same income taxes. For a basic rate taxpayer, this means that a £20,000 pension contribution could save up to £4,000 of personal income tax plus the national insurance compared to salary earnings, or up to £1,750 compared to dividend earnings. Purchasing and protecting a business premises. Something we'll explore in more detail in a future video, don't forget to subscribe, but a very unique aspect of a SIPP that certainly isn't available through an ISA is that you can use your SIPP to buy commercial property, even your own business premises for your business. Now the benefits here, or the implications, your business can then rent the property from your SIPP with the rent regularly adding into the pension pot tax-free. And since rent is an allowable business expense, you can then use this rent to reduce your corporation tax. It's worth noting that the rent must be at a market rate, so you can't hyperinflate things here. The property will also be safeguarded from company creditors should something bad happen with your business. This is because the business isn't the one that owns the property, the SIPP does. Another benefit is that you won't pay capital gains if and or when you dispose of the property and if you make a gain. So, which should you use? For most UK entrepreneurs, this shouldn't be the question. It should actually be, how do you employ both of these tools? For example, you could use ISAs for their added flexibility and liquidity, building up your ISA over the long term, meaning that eventually you'll be able to benefit from tax-free income, all the while leveraging a SIPP for long-term tax efficiency and retirement planning. This is especially true if you have a limited company and your business can contribute directly to it, since the corporation tax savings are one of the few remaining areas where business owners can tax efficiently move funds from company profits into personal wealth. I'd love to know what people are currently doing. Are you putting money into an ISA, a SIPP, or both? Please comment ISA, SIPP, or both, depending on your personal preference. A like is always appreciated, and if you want to make my day, please don't forget to click subscribe. Thanks so much for watching, and I'll see you in the next video.